Okay, hello traders and good morning. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, March 5th. Michael Boutros with you this morning. Hey, Patrick, Peter, Pete, everyone in the room. Great to see you guys this morning. So what an awesome week. So much volatility. I hope you guys are enjoying it. Hope you're staying protected and keeping that risk management under control. Lots to discuss. You got non-farm payrolls on tap tomorrow. You also get Canada employment on tap at the same time. So that double whammy jobs Friday will have us looking at dollar CAD for sure. But on the menu for today, DXY, Euro, Sterling, Aussie, Kiwi, CAD, gold. Pete, I'll start off with the SPX since you brought that up. Dollar Swiss, and I did give an update earlier in the week on dollar yen. I haven't really been trading it, but we'll take a look at the levels heading into non-farm payrolls. Covers pretty much the entire spectrum of dollar majors and commodities, so let's jump right in. I don't have crude on here. Let me put crude on there as well at the bottom there. All right. Thank you, sir. Patrick, hope all is well. He says, same to you, sir. Amen, Kelly. Great to see you guys in the room. All right, so let's jump right in. Here's we updated the SPX on the 3rd. Here's our SPX update. So this is what it looked like. As always, guys, anyone who's new to the room, always remember that if you don't see the accompanying daily and weekly charts, it's only one click away. Previous updates provided for you right there. I'll take you right in it. So here's the weekly chart. This is just what I want to show you. This was back on the 1st. We had broken major upslope support on that massive weekly candle last week, taking us below former swing lows, slope support, this 618 line of that extension. And here's what it looks like now on the weekly charts. Again, we look at this in log scale in reference to the distance in time and price that we're looking at. Look at what this thing did. It bottomed out at the 50% retracement. This is the same chart of the advance. You have the outside low week reversal close from the June decline right here. That's 28.74, and then you have the median line for the parallel for the pitchfork. It's exactly where we bottomed. Look where we found resistance this week, guys. Right there. This is the same 618 line. Okay, the 618 bisector of the pitchfork. This is the pitchfork dating back to 2009 and 2011. It's uncanny, right? And you also have former channel support and now resistance. We probed right into there and pulled back. Excuse me. So look, we're getting a lot of massive 1,000-point days. We already had 2,000-point days, and Thursday hasn't even started yet. The volatility seems here to stay for a while. The coronavirus is, the headlines are going to continue to circulate. They're only getting worse here. So as I said to you guys earlier in the week, when this thing was ripping higher on Monday, I don't think this thing's over yet. Here's the daily chart. Little bit messier, okay, but the levels remain the same. Here's what the daily chart look like back on the 1st. We tanked through all of these levels, bottomed out right here. That level we just talked about, 28.55 is the October low, 28.65 is the 50% retracement. Here's the rebound. We've already paired 50% of the decline. So scratch this low day close now. 50% of the decline gives you 31.25. We capped out yesterday at 31.30, okay? And here's the pullback. Likely to see some more back and forth price action. The pivot is still 29.84, the same level that we talked about here, right? That's where we found resistance on the initial rebound. Once we broke through it back on the first day of trade for March, it's been support ever since. Here's support back on the 3rd. Here's support back on the 4th. That's still the level to watch. Huge pivot in price. All right, daily chart, daily chart. Pete, here's what it looks like on the intraday, man. And here's what we looked like early in the week. We were coming right into that October low. We're saying watch out for a little bit of a rebound. Major pivot you want to look for is 30.60. Okay, we broke 30.60 and popped right up into 31.25. Here's the 30.60 levels right around here. So we popped right through the median line. What happened when we popped through the median line? Found some resistance at that parallel. We tried it again in overnight trade. Yesterday, there's that 50% retracement holding. Here's the whip back. Even if this thing rallies higher, here's the 120 minute. Even if it were to get into 31.89, in my humble opinion, Pete, it would still be bearish, man. Right? So here's what it looked like last night. Oops. Okay. We had just come off that 50% retrace. I told you guys that we need to get below the 618. It was at 30, it was at 29.55 last night. We tapped it. Okay. We didn't even get that low. And then we tested it again and made a new high. So the 618 moves just a tad higher to 29.59. But I mean, the downside levels remain unchanged. Okay. So from here, risk is lower below 31.89. Near-term support targets at 29.91, 29.59. And at the end of the day, if you get back below 29.59, if you get back below the median line, you're basically looking for a resumptive move, right? Deeper cut. But so far, so good. Pete, does that help? So my point being is, even if you look at the momentum signature, we were in deep oversold territory. Look on the rallies on the intraday chart for even the 2-hour, really struggling to get any type of momentum above 60. Still telling you that the momentum hasn't, momentum profile rather, hasn't broadly shifted yet to the upside. So you still need to be cautious here. Non-farm payrolls are on tap tomorrow. We'll go over that in just a moment as we go over the DXY. But any other questions here on the SPX? The levels have been outstanding. It's been freakish how clean this thing has been. Obviously, the momentum and the magnitude of the daily thrusts have been a little bit more than I even expected, but the levels remain pretty clean. Peter says, yes, thanks. Hey, you're more than welcome, man. So that's SPX heading into the US Open. Seeing some downside pressure here already. So just as a quick update here, some things hitting the wires, at least in the city. Got some new cases. I think we're up to 10 cases in Manhattan. There's a new case in Jersey, just right across the river. It's getting pretty scary. And aside from the implications of the human toll and all that, and obviously we feel for anyone, but we haven't really seen the impact on the real economy yet. I can tell you just from my end, guys, some ancillary sort of anecdotal notes. IG has is supposed to be participating in an expo on Monday. They have an expo venue out in Brooklyn. Are we going to still do that? Is that something that we should be participating in in a large mass auditorium? I don't know. I'm supposed to be giving a lecture for an hour on confluence, support, and resistance. These are the type of decisions that every business is going to start making over in the coming weeks. And if that starts to be a concern that actually hinders business output or business function in general, whether it's travel, whether it's venues, whether it's expos, whatever, what is the impact on the economy going to be? And I think that's why the Fed moved to do what they did. It's funny that they did that on Tuesday, guys, right after our webinar. We were just talking about the implications and the rumors that were circulating. I don't know if it struck you as being ironic. We were talking about the rumors that were circulating that they would even come out ahead of the March 18th release and make an emergency cut. Well, they did it. 50 basis points. What happened? Markets rallied and then quickly took it right back. Why? Well, that was largely priced in, right? But it sends two signals. Markets basically forced the Fed's hands with the massive declines that we saw and this raveling of, or unraveling, we should say, of the coronavirus all across the country. They kind of forced their hand. So the Fed came in, they did that cut. Markets were like, oh, okay. As soon as you did that, you went to Fed fund futures and markets were pricing in another 50 basis points by the end of the year. Some even pricing in even more, right? In fact, let's take a look right now and see where they are today. Here's what Fed fund futures looks like now. Okay, so for the March read, there's actually a building consensus. Look at this. This is for the March read, guys. Next in like 2 weeks. We're already at 1 and 1 1/4. There's already basically 100% consensus that we're going to get at least another 50 basis point cut or 25 basis point cut. Okay. There is a 47% chance markets are pricing in that we're going to get a 50 basis point cut. So already on top of the 50 we just got, markets already slamming expectations for more rate cuts. So it sends two signals, like I was saying. It's telling the markets, okay, Fed's there to catch just in case. We're going to ease things off. But it's also saying that the Fed is seeing a rising concern. And that's where you're seeing it start to hit sentiment. And more so than sentiment, guys, and even what the markets do on an intraday basis, it's all about the consumer. If this filters down to the consumer, where the everyday person at home will be like, you know what, let's hold off on the movie theater this weekend. You know what, let's hold off on the mall this week. I don't think we should be going to the mall. You know what, let's hold off on this event. Let's not go to that concert. All of these things, if it starts to that sentiment starts to filter into the consumer, that's where the real concern is. Remember, U.S. economy is largely consumer driven. It's the biggest output. So um, this is likely to get worse. This is likely to get worse. So I went on a little sidetrack there, guys, but a quick note on where we are sort of on the broader scheme of what's really hitting sentiment. So with that in mind, what does the DXY look like? Here's what it looked like earlier this week. Back on the second. Okay, so beautiful chart on the weekly. Nothing's changed. Same slope, and it has been dope. Let me tell you. Here's the reversal off the. Let me take this off log. Off that upper parallel we talked about. Here's the level in focus into the start of this week was 97.37. The swing lows that we made back there into the close of January and open of February. You also had this parallel extending off the lows that we made back in January of 2019. Caught the lows back in June. On a closed basis is exactly where we tested into the start of this year, right into that slope again. We need to close below this to validate the move, but all things held constant, looks good. We're now coming on the next upslope support, just lower on the weekly charts, extending off the lows that we talked about in June and September. Comes in just lower, around 96.70s or so. You also have former slope resistance, then support. So as long as we hold, ideal scenario closes below 97.37, near term bearish inval back up at 97.87. If we close the week back above this, you kind of discount this drop. But all things held constant on the weekly chart, that's sort of the focus. Momentum turn right at 60. Everything's super clean. In fact, I left this on. I don't know if you guys can see it at home, really faint, just to show you guys how former slope can really add just a little bit of a dynamic, an added tell on price. Here's a 3-point touch, so it's a confirmed slope. We tapped it again back in June of last year. Got really messy into the break, but on the underbelly, another perfect hold of resistance. And again, gauge these things, guys, on the closed basis. They tend to be a lot cleaner. All right, that's the weekly chart. Daily chart for DXY looks like this. So the slope we've been following just off September and February, the median line is now in play. 786 retracement, 9712. We talked about the lows from November and October of last year. That was also 9711. We're trading there right now. It's a little bit hairy, in my opinion, to get excited about anything on the short side of the dollar from here. You're trading at multi-week lows. You're trading into slope support. Wouldn't initiate anything fresh from these levels. In fact, as I told you yesterday in the update, I was actually playing shorts on the euro into that support zone for the last couple of days. Took a couple of those. Last piece of it got stopped out at break even, but it's just been about that recoil about off resistance. So in dollar, same type of deal. You made a new low today, but you're still tempting a sort of near-term exhaustion bounce. Here's what it looks like on the intraday chart. Okay, so this is the 120. Here's the 240. Just zoom out a little bit. Beautiful break. This wasn't a gap. I don't know why. Whoops. Trading View has been putting that as a gap sometimes. In any event, it's not a gap. It was just a quick sudden move. But here's what the 240 looks like. Okay, so getting a little messy here at the 786. I don't really like that we're kind of wishy-washy through it. At the end of the day, you are sitting at support on divergence in momentum. Really weak signal, but it's there. I wouldn't be looking for anything short beyond here. Now, that being said, if US markets come online and we buckle below this parallel on any recovery, if we fail back here again, the continuation lower has us targeting 96.36, the swing low. The 2019 open is 96.17. So levels have been clear. I'm just very hesitant to do anything fresh, sort of on the short side here. I want to see some sort of recovery to get back in. Patrick says, I got a blank screen. Guys, do you still have a blank screen? Okay, bear with me one moment. Guys, did that fix it? It's back? Okay. Sorry about that. AV is fine now. Okay, thanks for that, Eman. Patrick, thanks, guys. I apologize about that. A little bit of a glitch there. So, any questions on DXY? Any questions on DXY? I wouldn't be jumping into anything, again, fresh from here, but if this were to hold, like I said, I think this is where we lost the screen, and we were to buckle back above sort of 97.12 into the close, or even if this were to break lower, is what I was saying, and we kind of tested this as resistance, if this holds, then the downside targets are pretty clear. But the ideal scenario, this is your bearish invalidation level, 97.71, 97.87. I want to see that resistance hold if DXY is going to break lower on this move. Okay, non-farm payrolls on tap tomorrow. What a setup. What a setup, right? So if the dollar rallies on non-farm payrolls, look for exhaustion there. If that breaks, you're probably in for a much larger correction. It would have to be an insane number, I think, for that to happen. If the numbers come out weaker than expected, you might not get a chance to jump in. But if this breaks, it's likely going to be a quick drop towards, again, 96.17 is the next major target, 2019 open. Then you have the low day close at 95.55, both big levels. You know, I was talking with some guys around the city, guys, and some of I've heard it. I don't want to throw this rumor out there, but I've heard, you know, that maybe the Fed knew that we might get a soft number on Friday, and they wanted to kind of preempt that with a decent forward move on this rate cut, because we might start seeing it start hitting employment. I don't think it's way too early before coronavirus concerns really start hitting the employment sector, guys. We're already like way far out there. The labor force participation is pretty decent. Remember, tomorrow we're expecting a print of 175,000. Last month we got a print of 225,000. Look for those revisions. Unemployment is expected to hold 3.6. So outside of a real big deviation from the expectation in non-farm payrolls, we're basically looking for a bounce here to sell in DXY. A break below this parallel, a break below this slope really opens up a test of the yearly lows, essentially. Questions? I don't have the 2020 open here on the intraday chart. Let me throw that on there. All right. So SPX number one, DXY number two. Here's Euro. So this is what I've been like executing on, at least for the last couple of days. We're trying to make another run on it now. I'm not doing anything here, but the big level, right? The big level that we talked about. Remember, it was adjusted. We were talking about 112.86 into 111.86 into 112.08. We made a new low. So on readjustment of that retracement, it gives us a focus range of 111.70 to 111.86. We're there right now. Just higher. You have the stretch high from the weekly, that first week of trade for the year, 1240. But this is big. This is big. Okay, this is the weekly chart on euro. Here's what it looked like last night. Again, the previous chart to get that daily and weekly. Here's what it looks like as we were starting off the week. That was your first level. We plowed right through it. This is the big, big, big confluence zone. 618 of the drop from June, 618 of the drop, or excuse me, of the ascent from 2017. Long-term fib, short-term fib, slope resistance. It's all right here, baby. All right, big level, big level. Daily chart looked like this to start off the week, right? We've plowed through all these targets. We're up here right now. Here's the daily chart. Oops. Okay, it's been a quick one-way trade, guys. The whole focus for me has been trying to play little kickbacks off this. And this is where being confident in your strategy, guys, and being super nimble. A lot of people would look at this and say, "How the hell did you do anything on the short side here and actually play it?" It's a big resistance level. Now, again, we're trying it again today. We're trying to press through. If we see an exhaustive trade, I might again take another stab at it into the U.S. trade session. We ultimately do want the top side breach, okay? But resistance is resistance. And then hell, if there's a couple of intraday positions that I'll take against it, I got no problem doing that. Quick, tight stop. But this is the region. Here's what it looks like on the intraday. So you can see multiple attempts at a topside move here failed. This is the third attempt here. Again, here's what it looked like early in the week, right? As we opened Sunday, that was the level we wanted to sort of keep in mind. Was on this breach into this region. We broke right above that 618 and just went right into this region. We've been here ever since. Back, and here we are testing again. Stops would be a need against this high, so it's a tight stop as it is. Wait for the U.S. Open, see how this reacts. I can tell you that from the test of 110 at 95, which is a level that we've been watching for a while already, both of those tests have been spot on. So strong support here. Strong support here. So I want to see how this looks into the U.S. Open. If you get an exhaustion move, something like this again, into the Open, don't play anything outside of this range. Key support still at the weekly Open, but don't play anything outside this range until we break it. Now, if we breach, I find it hard to believe that we would breach right before non-farm payrolls, outside of a major new announcement or some new headline risk outside of the coronavirus. But if we topside breach here, it should be an accelerated move. It would be a breach of downslope resistance, a breach of Fibonacci resistance, former monthly swing highs. You name it, it's all stacked up here. So that's all I want to say is caution for those of you who've been trying to play the short side. I think it was you, E-Man, or was playing on the short side of this early in the week. Just be cautious, right? Because it's still big resistance, but you're heading into the end of the week. You're heading into event risk with non-farm payrolls, and you have this looming virus thing that could hit us at any moment with a risk market move. End of the day, you're at resistance. Eman says, yes, I'm still in my short trade, Michael. Yeah, I mean, it fundamentally hasn't changed, Eman. The first level was 1095. We've tested it twice, so pay attention there. But if that gives way, I think you get the spill back into the weekly open. Ultimately, it's still a constructive trade, but we are certainly at resistance, and there's no denying that. Patrick says, Michael, if it breaks through current resistance, what would be the next level to look for on the upside? So the August high, Patrick, comes in at 112.50, and then 112.99 is just going to be the actual swing high that we made. I'm sorry, 12.99 is... 12.99 is actually the November 2016 high. It's the pivot, and break higher than they made in 2017. It was the low they made in August of 2018, and just higher at 113.06 is actually the 618. Actually, we can drop that. I'm sorry, it's the wrong 618 at this point. Gotta come down here. Hmm. Yeah, I don't know how much emphasis you want to put on that 618. I would just keep it with 1295. Excuse me, 1299. So 112.50, 112.99 would be the first initial upside targets on a breakout here, Patrick. I always like to pay attention to levels that have a little bit more technical significance. Just a high. The reason that retracement made sense last year, because it was last year's range, is essentially a high low of the 2019 decline. But now you're kind of taking it from mid trend to the new low. So you're not encompassing anything that is significant in time or the stretch of the trend. So I wouldn't pay too close of attention to that. Does that make sense? Patrick says, great, thanks. You're more than welcome. Yeah, these are the first two initial upside targets I definitely pay attention to. Might be worth another stab. We'll see how it looks into the US Open. Here's the 30-minute. Just made an outside reversal candle there. Okay, we'll revisit this. All right, that's euro. Number 4, sterling. Here's British pound. All right. So we're at resistance in sterling. This is the level that I wanted to highlight last night. Here's with our update. Euro, no change to those levels, guys. So we're still ping-ponging right in this region. Here's what sterling looked like last night. As we were trying to make a break of the weekly opening range, the top side resistance was 28.47. The major level we're looking for is still 29.07, 29.10. That's a 38.2 retracement. Confluence to the 618 extension. I'll show you the levels in a moment. But this is really like the kind of the limit for the upside. We need to see something happen here. It needs to break this with a more definitive thrust if this is legit. This is sterling, guys, the king of the throwover, the king of the false break. So if this doesn't give us a thrust here, I'd be cautious to chase this any further. Although I do like an ultimate breakout in sterling. Resistance is resistance, right? That's where we are. Here's what the weekly chart looked like. No change to any of these levels. So we're testing yearly open support from last year. It's 27.54. That's where the bounce materialized. We're still in this region. Bearish inval for the broader picture, still 30.78. So still got a way to go before this really clears weekly trend resistance, right? That would tell us that we're right back on track for the upside. So no change to the weekly chart. Here's the daily. Here's what it looks like now. Okay, we are at trend resistance. So at 38.2, the drop gives you 29.11, just higher, basic slope resistance, right? This slope has been very fruitful off the highs that we made in December, and then again, that high that we made just last month. We took a parallel off that, caught literally the lows to the T. Here's the upper parallel. A little ahead of schedule, right? But we're there. Watch sterling today. Here's the intraday chart. And here's what it looked like last night, right? So we were just making that top side break. This is the level we need to see a reaction at. We're trading above it now. And yes, over the last 3 hours on the pullbacks, we start to find some support there. But watch it into the US Open. It could still just buckle right back below. In fact, one thing that I like to do with these guys is sometimes I'll just take a parallel of that slope and I'll extend it off of the breach highs. And if we do that, it's sterling. This could very well still be a near-term high that pulls back. Now, does that mean I should be looking at a short position, Mike? I wouldn't necessarily, not my cup of tea here, right? Because I like the topside breach. So If we do pull back, maybe look for support back at 28.47, 28.50s region. But watch for a reaction here is my point. If it breaches on the pullback, again, this is where you'd want to find support. 29.90 on the upside, 130.24. It's the 618 of the drop. Questions on sterling. Again, a trade where the levels have been like super clean. You know, the previous sterling update here. Here's what it looked like as we were like just starting to range in the week right above 2019 open. There's the topside breach. There's the move. Pretty quick into resistance. Look for reaction today. Questions on pound. Okay, I'm gonna pick up the pace a little bit here. Let's circle. Oh, well, I can't pick up the pace now because we're going into Aussie. So for those of you who love the commodity currencies like I usually do, you know that we've been estranged from the Aussie for a couple of weeks. I haven't really been writing about it because I've just been thrown off. You know, when the longer term picture gets murky for me, I don't even bother jumping into the intraday. So here's what Aussie looks like on the weekly chart. Did a whole kind of rework of this yesterday and Kiwi, really digging in deep into the metrics, trying to find some guidance for this move. At the end of the day, here's what we came up with. It's the same slope that we've been working with. We turned right ahead of slope support. This weekly candle is really messy. Major level I want to look for as resistance is the same level. And point in fact, this is what we were talking about the last time we reviewed Aussie here, was as we were breaking below 60.60. Okay, it's the 2008 low we closed. We turned there at the end of September trade last year. Big level. We broke and closed below it. That was sort of the onset of this big drop in Aussie. That's the level to be on the upside to get any type of validation that a more important low has been executed, that a more significant recovery is underway. So take these levels on face value. This is your weekly chart, guys. None of these levels matter until we get a weekly close above or below. But this is the critical threshold. 60.60 on the upside. If we break lower, there's nothing to like 63.40. A lot of room. So weekly chart. Daily chart looks like this. Okay, and this is the same chart again that we highlighted yesterday. So slope resistance, right? Nothing fancy. Basic trend line resistance right off of the December highs. You got 1 touch, 2 touch, 3 touch confirmed, 4th touch, 5th touch into the start of the month with that move that we made right on Monday. Here we are again. Here we are again. The big sort of pivot in my mind, like I said, that would validate a breach of this descending channel would still be, you called it, 60-60. 60-60 is now also 60-62 to be precise, a basic 38.2 of the drop. So you have another trend line there with a 3-point touch that converges. You have the 2008 low week close and a 38.2 retracement. That, in my mind, would validate, like I said, larger breakout in Aussie. Here's what it looks like on the intraday. So as it stands, and I'm going to zoom this out to the 240, give you a better picture. As it stands, right, you could almost dismiss this as a false break. Here's the push. You don't want to see acceleration, not getting it. Here's the pullback lower. Initial support at 65.67. Look for a reaction there. Bullish inval is the low day close. If we get below 65, forget it. We're probably getting resumption in a much deeper cut in Aussie. Very hesitant on this one, guys, and I'm very nimble. So, you know, we've stayed away from this ever since this break. Well, guess what? It's the same level that needs to breach as resistance to get the resumptive move. Okay, so on the initial focus right now, all things held constant, looking for support in Aussie, either into 65.68, or if that breaks the objective weekly opening range highs, you're looking for a drop towards the low day close. Non-farm payrolls on tap. Let's see if we can't get this move here. Questions on Aussie? So Kiwi, not quite as clean, right? I was telling you this yesterday. The difference here is that Aussie came back off of multi-year lows, broke above last week's high. Kiwi didn't. Kiwi came off multi-year lows and then halted well ahead of last week's high, which comes up at 63.60s almost, 63.50s. So not quite as convincing, let's say, for the argument for a turn here in Kiwi, but nonetheless, the picture here on a rework of the slope looked pretty clean to me. Here's what Kiwi looks like on the daily chart. Well, first of all, here's what Kiwi looks like on the weekly chart. All right. 618 extension of the drop. This is from the drop that you made back off the 2017 highs and 2018 highs. 618, 1618 of the extension or of the drop, excuse me, gives you 6178. The 2015 swing low comes into play at 6196. Man, that's basically what you've been finding support at. Now, if you zoom this out a little bit, that trend line is extending off the lows that you made back in 2000. So if you take the 2000 low and the low back here in 2009, this is the third reference point, fourth if you want to count these two here, but you get the picture, right? And then that converges on the 2015 lows with the 1618. So a beautiful spot. That's all to say, a beautiful spot. Last week's low literally was right in that range. The low executed at 6191. If you ever have your doubts about technical analysis, look at some of these charts. Should wake you up. So look, at this point, you just want to use some caution. We're coming off support. This is the first area of resistance. You'd be looking at the low week close from last year, 63.13. See if we can get a weekly close above that. Here's what it looks like on the daily chart. So an extension just off the last late highs they made last year in July and specifically in December. The 618, decent pivot, break, turned as resistance, turned ahead of resistance. Look where the median line is. It converges right on that same region, 2015 low, and even over the next couple of days on the 61.78 level at 1618. So critical support, right? If you see a break below this, you're likely to see an accelerated drop. So the level to beat, 63.47, 2016 low, basic channel resistance. If we get through that, you're looking for a rally towards 64 handle. Initial support, the low day close for this year, the one that we made last week, the close of February, comes in at 62.44. I want to see that hold as support if this is going to work. Here's intraday. Okay, 62.44, there's the low day close. 63.47 on slope resistance. And again, a breach above 64.24, basically the 64 handle is what would validate sort of a larger turn in price for Kiwi. So very similar scenarios on both. You want to approach these turns very nimble, guys. It's never prudent to be the guy trying to call the low, but certainly when the conditions are there, when the technical factors are rearing their face, it's kind of stupid not to pay attention. Questions on Aussie or Kiwi? I miss these guys. I haven't traded these guys in a while. I'm looking to dip my toes back in. Just want to wet my beak back in some commodity currencies again. All right, so that is number 6, Aussie and Kiwi. Number 7, here is the last of the commodity currencies, dollar CAD. And again, tomorrow brings big event risk with the double jobs Friday from Canada and the US. Here's dollar CAD on the weekly charts. It's not the cleanest thing on the weekly, not much to write home about, but it's really continuing to just highlight why this region at 33.70, 34, 33.90, this region right here was so big for me. We closed last week right there. We gapped higher into the open. We filled the gap, but now we're trading above it again. So look, on the weekly chart, I just want to see how this plays out with respect to this zone. Recall that this zone is the 618 retracement of the entire drop off the 2018 highs. It's the 2019 high week close. It's basic slope resistance. It's the high that you made back in September. So much was lined up into this region. I don't like that we've pivoted above it and below it twice now. So watch the weekly close in relation to this for guidance. Okay, that's all I'll say on the weekly chart. The daily chart has a little bit more of an objective resistance zone here. The 2017 open comes in at 34.35. You have basic channel resistance. This is a slope off the low for the year, just extended off the highs that we made into that February open. Caught that move. Gives you support 32.76. Is the kind of the key support. A topside breach from here, you're looking for 35.12. All things held constant, this new slope has us looking for a reaction here, right? And we haven't been able to break above. So I think Jamie has been on the same side with me on this one, that we were both thinking exhaustion pullback. Exhaustion pullback. I mean, you had some divergence on the daily chart. Really nice sort of gap and fail to move lower. It's been resistance. Want to see how this plays out tomorrow. Not prudent to kind of get heavy on dollar CAD ahead of tomorrow's event risk from both sides. But the idea, the scenario, all things held constant outside of deviation and data, is to fade some sort of exhaustion rally. Here's what it looks like on the intraday chart. And here's what it looked like. So Kiwi and Aussie, none of those changed, look the same. Dollar CAD. Here we go. So here's what it looked like into the open on Sunday. No change. 33.30 was a level we needed to beat to get the thing going lower. That held. 34.35 is the level to beat in the upside as resistance since we started the week. That's also the weekly open. No help there, still resistance. And this thing is pretty well defined into its weekly opening range right here. It's a massive range, but that's what you're looking for. Topside breach. Look for, I don't want to say that you want to limit out here, but look for a reaction there. Really 35.12 is the target in the upside if you do see the breach. But from a slope standpoint, watch that if you do see the breach. Both of these levels of interest for possible exhaustion, by the way, tomorrow if this spikes higher. Michael, what are the red circles on the chart? Thanks, Ted says. And what are the orange circles? Ted, welcome aboard. Great to see you in the room, sir. So the red circles typically are going to highlight targets or confluence zones. So zones where we're looking for some sort of reaction, Ted. If you're in a short, it's going to be where you're looking to take your limit. If you're looking for new entries, it's going to be where you're looking for possible exhaustion, but they're hard targets. The yellow circles are sort of the if-then target. If this breaks, this is the next objective on the upside, right? They're softer targets, if you will. But the red circles are basically where we're looking for inflection, where we're looking for more prominent technical moves. Does that make sense? He says, okay, great, thanks. You're more than welcome, Ted. Welcome aboard, sir. Again, feel free to throw out any questions that you guys have, as always. So let's see. The more expected move is going to be the red ones. Those are more of like what we're favoring. So I'd love to see this hold, but tomorrow's non-farm payrolls and CAD employment, if there's going to be a time of which you're going to break one of these levels and kind of fake it out, it's going to be tomorrow. Look for possible exhaustion on the upside, all things held constant in dollar CAD. That's all the majors, aside from Swissy and Yen, which we will cover if we have time. But we're running to the end of the session here, so I want to make sure we get gold and crude. So here's number 8, gold. Look, this is resistance, a little bit higher, 1658, 1662 is the level I gave you guys on the last update, which was on the 3rd, right here. Okay, so it's been a pretty clean move. A break above 1611, as I told you guys earlier in the week, was our near-term bearish inval. That was objective weekly opening range break, looking for a Thursday, Friday high. Well, it's Thursday. The high day close for the year comes in at 1658, excuse me. The 1618 of the extension off the low gives you 1662 right here. We are there now, knocking on the door. If you're going to get failure, this is the level. Now, the one thing that we've been talking about with gold, and you know that we've been calling for sort of a larger correction in gold for some time. We got a pretty massive spill last week. Was this the magnitude of the correction that we were looking for, Mike? Should we basically be looking for resumption now? Look, for me, this is kind of the line in the sand. If it breaks back above the high day close for the year, if it breaks back above the 786 retracement of the decline, if it breaks back above the 1618 extension of the ascent, yeah, I think we're probably looking for a resumptive move. Okay, remember, this is broadly an uptrend. Our whole argument is that we needed a larger correction after that, rip into the February high. So my point being, if we're gonna fail, this is where it needs to fail. It already, tried to come up into this level yesterday and failed, but here it is. Look for reaction right here today in US trade. If we close above 1662, don't fight it. Resumptive trade takes it higher. 1689 is just a soft target. You're looking for 17 and 1713. That's a 764 retracement and converges on slope resistance up here. If we fail here, if it spikes tomorrow, if we hold and then tomorrow's NFP spikes higher and then pulls back below, I'd short that. I'd take a quick pullback, look for a move back towards upslope support. 1625 would be the initial target, but you get the picture. Ultimately, a bigger pullback, we're going to buy that again because this is in a larger ascending position still. But man, this is big resistance. And if it's going to fail, this is sort of definitely a pivot I'd be looking for in gold. All right. Any questions on gold prices? Okay, quick reference on crude. I don't really have a very strong opinion at these levels. I just wanted to bring it up because I know that a lot of you guys are looking at this trade. Our last update, actually, I don't even think I gave you guys an update in the updates here as far as the reports. I just wanted to show you this chart. This is the daily chart that we reviewed on Monday and Tuesday. Man, like that low, that slope that we were saying, hey, look, there might be slope here, ended up that there was some slope there. Here's the rebound, but we're testing the underbelly, that's 764, it's failing as resistance. Look, at the end of the day, 50, 49, 60, this is the region of key support. The only thing that would put me bullish would be a breach above here. So at the end of the day, all of this could be still a washout. A corrective move into 49.60, sure. 52, might be shaky, but all still within the confines of downtrend resistance. So keep that in mind. Keep that in mind. It's funny because every time crude rips up like $1, everyone starts saying, "Oh my goodness, the low is in crude." Chill. We're not there quite yet. I still think we can even get higher from here, but the real test would be whether we were able to clear anything as far as downslope resistance, which we haven't necessarily done yet. I was looking at this slope, this parallel, 1 touch, 2 touch, 3 touch, I guess. Like, what is that, right? You're not getting a pivot on the underside. You're not getting a pivot on the upper side. So keep your focus on the dominant parallels here. All right. So just a quick note there on crude. I still think you can get some more upside. At the end of the day, you need to clear like 50 before you really start to suggest that a more important low is in place. Dollar Swiss and dollar yen, real quick. Here's dollar Swiss. We put out an update on this not too long ago as well, back on the 2nd. Here's what the dollar Swiss trade looked like. We were coming into big support, and I really wanted to see a bigger reaction here. Here's the daily chart at the 2018 September low. Look, we bobbled there. We got a rally back into that 618. That failed. We checked it again. That failed. Here's like a third attempt. And here's the parallel that we had added. We're testing the underbelly of that, or the underside of that right now. Just another cautionary note, not to chase the dollar lower from this level, right? Because on all accounts, you're coming into downslope support, you're coming into trend support. It's a tough sell for me. So look, either you get a break here and an accelerated drop, in which case we might miss it. If you get a larger reaction, look for slope as far as resistance is concerned. New bearish invalidation now, you can drop that to those lows that we made back into the start of February. So 96.28, 96.30 is the now new near-term bearish invalidation. Also keeping into account that that's also the objective weekly open. So you got a lot of clean levels here. It's just for me, more of the mindset that you're going to get some sort of pivot here. Either this fails and you get a little bit of a recovery, or if it breaks, we're not going to get an opportunity to get in. It's probably just going to plummet. And heading into event risk with non-farm payrolls on tap and Corona all over the place, I'm cautious trading these turns, right? So just a quick note there on the Swissy levels, no change to any of those scalp targets from earlier in the week. Last but not least, number 11, a quick look at dollar yen. I haven't done anything on this, but you have to admit, when this thing gets clean, it's not very often that it happens. But today, excuse me, all things held constant, you're poised to make an outside day reversal into fresh lows. Okay, that could be exhaustion at the lows heading into the swing low that you made in June of last year. That gives you 106.78. If that breaks and you close below that, an outside reversal lower could be sort of an accelerated drop. So you'd expect to see that 106 target hit pretty quick. That's the low day close from last year. So look for a pivot here at 106.78 is the point. If that holds into the close, this could be a classic exhaustion move, in which case dollar strength would give you a little bit of recovery. Now, near term bearish inval, key resistance, right back at those lows that you made back in December, right at the open of last month. That gives you basically like 108.42 into 108.50. All right. Michael, are you having a webinar on Monday? Pat, great question. It's still slated for Monday on Daily Effects, and all things held constant, I want to say yeah. If I do end up doing that that lecture at the expo, I might have to cut it short, but all things held constant, I am planning on doing it. SB webinars next week are unchanged. We're still going to have those on Tuesdays and Thursdays either way. Any questions on dollar yen? I don't even have any near-term targets that are going to be more effective at this point, but here's the slope for reference. Here's your objective weekly opening range high. Key resistance, downside support targets. All right. Here's the last dollar yen levels, unchanged, guys. The only thing you want to scratch on this is the retracement, because we've made a new low, so that retracement is null and void. Downside targets are unchanged. Okay, that was a mouthful. Watch for the US data tomorrow, guys. It's going to be, it's been an amazing week, huge volatility. If you've missed out or you've kind of feel a little bit kind of gypped because you didn't get to take any on some decent positioning this week, guys, don't. Volatility is definitely on the upswing here, and there's going to be plenty of opportunities moving forward. Watch the data tomorrow. Net change in employment for Canada, by the way, they're expecting a print of 11,000. We got 34,000 last month. It's notorious for being massive swings. So don't be thrown off if you get that print. Unemployment is expected to uptick from 5.5 to 5.6 in Canada tomorrow. So keep that in mind also if we do get that release, that those expectations are essentially priced in. Again, non-farm payrolls, we're looking for 175 with unemployment holding 3.6 or better. All right, best of luck trading. Guys, have an awesome trading day tomorrow, an even better weekend. I will see you hopefully on bright and early on Monday morning on Daily FX. If not, either way, Tuesday and Thursday here on SB Trade Desk. Have a great weekend, guys. Cheers.